All right, guys. Hey, welcome to another episode of the Practical Wealth Show. So we're going to be doing this. So if you're listening to this on the show, you really want to go to the YouTube channel and view this also, because we're going to be going through kind of a presentation. But I've been getting a lot of questions about reverse mortgages, and there's a lot of what I call myth conceptions around it. So I have an expert for you. On this, Mr. George Vrban, and George is senior branch manager down in Florida, right in Jacksonville. And we met at a conference for my Circle of Wealth conference in January. And I had got a couple of questions recently. It says, you know what, when I get like 2 or 3 questions in a row, it's time to answer it, right? And and create some information on it that I can just say, hey, here's a resource, go to this show and we'll tell you the ins and outs, and then we can talk about it, because it's never the product, it's the strategy, right, George? And that's my philosophy. So George, welcome to the Practical Wealth Show, and tell them what I didn't tell them.
Thanks, Curtis. I appreciate that. Thanks for the invite again too. And yeah, it was good getting a chance to meet you down here in Orlando. So my background is the name of the company is Fairway Independent Mortgage. We're currently in 50 states. I'm licensed in 19 different states, including Pennsylvania, for example. And I work probably with some of the top insurance agents, financial planners like yourself, Curtis, in the United States, because I literally teach a lot of cash flow, tax strategies, a lot of stuff that people really have truly no idea about how this product can really work. This product has just always been known as a last resort or a desperation type play, right? So
right.
It's not the case, not
right.
anymore. It's literally there's a paradigm shift. And what happens is it's shifting now from people that are thinking this to where now it's truly being used as a retirement tool and part of the retirement strategy process for figuring out how to make people's money last longer in retirement.
I like that. I mean, baby boomers, especially, number one fear is running out of money, right? And nobody's saving enough money. They don't have, it's really, I don't even get me started with this. It's impossible to save enough money, all right, to live on it for 30 years. So you want to use all of the assets that you have to live the best life you can for as long as you can, right? And that's my belief. So George, with that, let's get into it, and
Sure.
and we'll talk. Tell them what you want to tell them, and then we'll, if I have a question, we'll kind of jump in and have a dialogue and kind of pull some good parts out for our listeners.
Okay. So, with that being said, I've been doing this for about 20 years, teaching all these strategies, and I try to separate myself from a lot of other people in the industry because I don't just do alone. I literally am an advocate for people 62 and over trying to figure out how to make their money go further in retirement using these particular strategies. And people that follow my lead, my clients still call me 20 years later.
Mm-hmm.
The kids call me, the parents call me, and I literally show so many strategies for them. They're just kind of blown away. And if you look at this slide, why wouldn't people really recommend a reverse mortgage? It's because of those misconceptions that people have, right?
Right.
And what is fear? Fear is nothing more than the absence of knowledge. And people don't get educated today. They hear these stories, they pass it on to other people. So let me ask, I always ask the audience the same question. If somebody were to tell you something over and over again and you thought it was true, but it wasn't, when would you want to know?
Right away.
Right. So, I mean, and what happens is you want to go to people that are in the field, that are experts in this field. You don't want to go to somebody down the street that has absolutely no knowledge of it, but heard a story from somebody else that heard a story.
That's right.
And unfortunately, this is what's happened right over the years.
Right.
And this is the most scrutinized loan in America today. This is a federally insured program from FHA. It is probably now the safest loan out there, probably more than any other mortgage out there, because of all the scrutiny that it's gone through over the years. So, again, why wouldn't people recommend it? Well, again, these are people in your industry, actually, Curtis, financial planners and that are way smarter than I am. This is not fairway propaganda, right? So this is, people like Dr. Wade Pfau, who's the professor at the American College, right? They've done all the research, and they really do believe that when you use strategically, right, this is the key. A reverse mortgage can definitely improve the sustainability of your retirement income, right? So this is what's going on today. These charts keep getting outdated all the time. Every time I put the slide up, it's already changed. There's about 10,000 people a day hitting 62 for the next 20 years. It's now 4,000 of them are still making mortgage payments in their 60s, 70s, and 80s, right? So it's already increased. So 1 out of 4 are basically still have mortgage payments. And there's a big demographic shift, right? All these baby boomers today. And what you're trying to do, Curtis, is just trying to figure out, okay, with everybody retiring, people are second guessing themselves. Should I retire right now with what's been going on out there with inflation and the market the way it's been? I think I picked the wrong time to retire at this point.
Right.
So this is the kind of stuff that people are kind of looking into. So at 62, 84% are going to most likely run out of money. At 60,
for the record, let me throw this in here. I don't believe in retirement, right? I believe that I want you to be financially free, right? So you can do what you, right, have the option to, to do what you want to do instead of what you have to. It's not an arbitrary thing, because retirement means so we use this because that's the rule, that's what people talk about out there. So I don't want to go into, my Curtis rant on that, but but the whole lot, retirement is an agricultural term, means to withdraw, to put out of use. Okay, so that is not the goal. Okay, and but you have tools and you have options. All right, so I just want to throw that in there so that because they know if they listen to my show, they know I don't like retirement.
Right, and then on the flip side, you got people that they have to work because they got no choice.
Yeah,
right?
That's what you don't want, right? See, so. You don't want to be I used to do this talk. I was doing the 403Bs for teachers about 20 years ago. And I would talk to them about, listen, you got to do this. You got to, you have to do something. So if you don't start putting aside money for what Don Buddy would call in Circle Wealth future lifestyle, I said, just practice these words. Hi, welcome to Walmart. Right, because you're going to be a greeter. Okay,
that's right.
And that is not a planned career choice. And so, but you have to do something today to have the life you want in the future. So, go ahead.
And then you got some people too that do it because they want to keep busy. You got some of those.
That's great. You know what I mean? Yeah. If somebody dropped $1 billion on me, I would do what we're doing now, and I'd be a high school basketball coach. I mean, so I would never stop working.
Well, I'm the same boat. I'd probably be a soccer coach again. Yeah. So, this is what's happening, right? 66, 50% most likely are going to run out of money now. There's lower savings rate, fewer pensions today, lowest return on investments. So there's a greater need now for security and certainty. And unfortunately, what's happening is that people today have one glaring blind spot, right? What is the biggest asset most people own today? It's their house, right?
Their house,
housing wealth. And it's ignored. Right? Because we've been brought up in a generation in the past where we have a fixed rate loan, pay off the loan, mortgage burning party, give the house to the kids.
Right.
That's just what we've been brought up on. Right. But here's one dynamic that's changed. People are living longer. Right. So if people are living longer, they're trying to figure out how to get more cash because they're running out of cash. Right.
Sure.
So what we're trying to show is that housing wealth can't be ignored anymore. We have over $10 trillion sitting in home equity today. That's literally almost as much as IRA money. Let's put it that way.
Let me say something here. So because if y'all can't see the screen, this is hilarious. So there's a picture of a man and woman, right? And it's a caption that says, I spoke with my financial advisor. They're on the beach. And it looks like I can retire at 62 and live comfortably for 11 minutes. Okay. And so that's hilarious. So if you're listening to that, I just wanted to put that out there. Go ahead.
I did that slide for you, Curtis, by the way.
Yes, that is hilarious.
So this is what's happening is and this is so what I'm getting at is with housing wealth being part of the retirement strategy. I really tell people that in order to be successful today in its challenging environment, right, you have to team up with financial professionals like yourself, Curtis, right, to figure out how do we utilize and strategize to use all the family resources and assets.
Yeah.
Right. And not just ignore housing wealth that's sitting off to the side. Right. So and how do we make your money go further in this particular case? So utilizing this product, it's called a home equity conversion mortgage. another word for reverse mortgage. A combined, here's the key part, combined with the right retirement products, can literally improve the sustainability of your outcome on your investments down the road by exponentially a huge percentage. It's just, it's that much of an increase that it can make that big of a difference.
That's good
All right.
stuff.
So there's that slide I was talking about. That's already outdated, right? 7 trillion. This concept here, if people do go to your YouTube channel, I recommend very strongly for people to really look at this slide. And this, to me, is probably one of the most important slides I explain to clients to make sure people truly understand really how the concept works. And let me give you an example. We have 3 buckets today in our life. We have an income bucket, which is where we're working. If you're from the ages of 18 to 80 years old, you're still working, right? That's one bucket.
Yeah,
the second bucket is your investment bucket, people that manage people's money like yourself, Curtis. And then you've got third bucket here is home equity bucket, right? And what happens is over time, people will do everything they can to earn income, and they try to set aside 5 to 20% of their money, and they try to set it aside in this nest egg bucket so they have something in retirement down the road. But then also at the same time, we're setting aside 25 to 40% of our income into bucket number 3, our house. Why? We have to, because you need a roof over your head. You need a place to live.
Right.
So we do this over time. So we've been
bringing. We were saying it costs money to sleep indoors, right?
You got it. You got it. It's exactly it, right? So what's interesting though is when you put money, when you set this money aside, the bucket in the middle here is liquid, which means that liquidity means that you have the ability to pull money back out. But when you put money into bucket number 3 in your house, is that money liquid anymore? No. And the answer is no, right? No. Exactly. It turns into equity, right? So in order for you to capture or try to convert that equity back to cash, you either have to sell your house or you can refinance. You could do a regular mortgage, but the problem is you still got a mortgage payment, then you're still back to square one again. But the other way to do it is to use this product to convert that equity back to cash to use and subsidize some of the retirement plans that you might have in the future. So here's what's interesting. And Curtis, you already hit on this. And stop me when we get to this part. But when people retire, there is no more earning potential. And this is where Dr. Pfau talks about this. It's the deaccumulation of wealth. It's spending down those assets. Now they have no choice. They're in retirement, post-retirement years. And we come down here to this chart. We go back to bucket number 1. And now we're living off what? Social Security income, pension, if they're lucky. And then here's the part that people start doing. Market changes. They have emergencies pop up. So what do they start doing? They start spending down bucket number 2. Right. And then when we run out of this bucket, this is the way this has been viewed. When they run out of this bucket, they now look over here to bucket 3 and they go, hey, let's do a reverse mortgage now because we ran out of cash. Right. I mean,
so the buckets, just for y'all not there and watching this, is so it's your income, it's your qualified plans basically, or mutual funds, insurance, IRAs, that kind of stuff. So see what they do is they fluctuate, right? So sometimes you don't want to take money out of that when the market's down, because now you're liquidating it, and that is really a loss once you take it out. We call it in our system, you're draining the tank.
You drain the tank, and that's where sequence of returns risk comes into play, right? So what we do is when we use this product the right way, instead of depleting your cash bucket, which is the one you manage, and pull money out at a bad time in the market, we're going to use the home equity conversion mortgage product as a way to subsidize your income during those times, because all the money we pull out of this bucket here on bucket number 3, which is the house, is all tax-free. So I tell clients all day long, would you rather pull out of a taxable bucket or a non-taxable bucket? Non-tax. Right. And the other part is, if we do this, we then let the portfolio get a chance to recover during a bad market. Right. Because the mistake, like you just said, Kurt, you nailed it right on the head. And that is, people make the mistake of pulling money out of their assets when it's a down market, and it takes that much longer to recover. And most likely they're going to run out of cash a lot faster.
See, because it potentially could be, and we use life insurance for this strategy also, a volatility buffer, right? To kind of, going back to the sequence of return risk. I heard Jeremy say, on another friend of mine's podcast, who's a trainer with Circle of Wealth. He goes, it's going, I call it going up the mountain, accumulation, coming down the mountain. So when you look at Mount Everest, a lot of people peak Mount Everest, but most of them die on the way back down, right? And so coming down the mountain is distribution, and how do you live on this money you've accumulated? How do you, and make it last? And so we're talking about going down the mountain without dying, okay,
without dying or tripping and falling down as fast as possible.
Right, exactly. So, faster you need to. Exactly.
Yeah, people accumulate wealth and they get to the top of the mountain, but it's really how do you get down from that mountain is going to be key. And are you going to trip and fall and speed through that and probably get to the end of the mountain real fast?
Right.
Or are you going to try to figure out slowly calculated,
because once it's gone, it's gone. Like if you spend the cash, I got a person like, there's wants to, oh God, I need $10,000 out this account. And I was like, you have a finite amount of money here. We need to look at some other, I might be seeing another customer. Okay. Because I'm looking at her thing going, you need to she got debt. I got to pay off this credit card debt. But you don't have enough to pay it all off. And now you've drained the tank for 10 grand, and you can never get back. And you still have monthly payments, and you still have a shortfall of $300 a month. So you're just putting Band-Aid on it because you can't take care of it completely. And that's where, and I've got a son that's like, no, I don't want to do that because I want the house later. That's the kind of stuff that you get when people don't understand the product. So I want to kind of bring this real, in terms, because this is what people are thinking. Oh, they're going to take my house. Right. And my kids want the house. Most kids don't want the house. First of all, let's start with that. They don't want your house. And, go ahead.
Well, that's the big one right there. So I cover 5 of the most common things people always ask me, right?
Mm-hmm.
So if you just hit on point number 3 of my 5 points, and point number 3 is simply, we've been brainwashed to figure out how to pay it off, pass it on to the kids, but they don't want it, right? This is what we're running into, people. And why is that? Because the parents are in their 80s and 90s. The kids are in their 50s and 60s. So when the parents ask their kids, do you want the house? Guess what they say? They say, no, we don't need another house. We're good. But you know what the kids will take?
Money.
You got cash. You got it. So cash. They can care less. I even have some kids complaining that they don't even want to sell the house, let alone want the house. So there's other ways to leave a legacy behind for children, right? How is that? Insurance. I'm your biggest fan, right? Insurance products, to me, it's tax-free. It's paid in 30 days. That's a better way to leave a legacy behind for your kids, because they don't want a house. They just want to go ahead, and if you leave them that money, then they'll be happy with the money. So with that being said, let me go back to point number 1. So first question people ask me, they go, George, the government's involved. Do I lose title to the house? Does the government take my house? These are the things people always ask me, right? And I said, no. I said, this is no different than any other mortgage. It's actually nothing more than a home equity line. That's all it is. And what people didn't know on a reverse mortgage is you can actually make a payment on a reverse mortgage.
I didn't know that. Okay.
Yeah. Yeah, people can, and they can pay it while they're in the house. They can wait till they sell the house, or they can wait till they pass away. So it's an optional payment plan, right? We took it from an optional payment plan, and that's what makes it so much more palatable, because you're on a traditional mortgage, you're required to make a payment. The banks don't care if you get sick. The banks don't care if somebody dies in their 60s and 70s. They want their money like clockwork. Where on this product, by simply switching gears and replacing one mortgage with another, we're now giving people the option, and the pressure is off, that if something happens to one of those 2 people, they get to stay in the house for the rest of their lives. They're protected. And you're protecting your spouse on this particular kind of program. Social Security is another area, right? So people are living off 2 Social Security married. And if one person dies, they have a mortgage payment. Well, they just had 2 Social Security incomes go down to 1 income now, right? The higher of the 2. And now the people are figuring out, I'm in trouble. Do I stay in this house now? Where do I go next? And all of a sudden the panic starts setting in. Right. But when you switch gears and you put this into this product, that's one of the protections, the intangibles like this, where it really does help out the spouse that's left behind, to make sure that they're taken care of in the event something were to happen to one person. So title wise, they stay on title. Nothing changes. That's number 1. Number 2, how does it work? They take the age of the youngest of the 2 borrowers, and this is a program designed for 62 and above.
Okay.
we can go in another podcast. Maybe I'll talk about non-borrowing spouses that are married, younger people to where 5-year-old married a 45-year-old, right? So that's a nice scenario.
I have one of those, right?
Yeah.
So,
Okay. So we'll talk about that maybe at a
okay.
later time, but they take the age of the younger of the two of you.
Mhm.
And by the way, my internet might be unstable, so let me know. So they take that percentage and they give a percentage of the equity of the property. Okay.
Mhm.
Now, let me give you numbers as an example to give it 3 different examples that can happen. If the house is worth 200 and we can only give them 80 grand of that, the first thing people ask is, wait a minute, you want me to tap into 80 grand of the 2. So what about the rest of the equity? Well, it's still yours. We're only 80 grand to tap into. We're not giving you the full 200,000, but the rest of the equity is still yours and it's still tied in the house.
Okay.
So you got still plenty of equity, but we're giving you. So the first example is going to be, what happens if I have a $60,000 mortgage? So we're going to take part of the 60 from the 80 that we're giving you, and we're going to get rid of that mortgage so you don't have that payment anymore.
Okay. Mm-hmm.
Okay. And then it still leaves extra, how much? An extra 20,000 to work with.
Right.
That they can do whatever they need. If they need to pay other credit card debt or some other things they need to do project wise, they have some extra money. That's like the best case scenario. We wipe out a mortgage and give them extra money. That's like the best scenario that can happen, right? So that's number one. Number two, what can happen? Well, if the house is 200,000 and we give them 80 and their mortgage is 80, well, there's no extra money, but what we did was enough money there to do what? To pay off the mortgage.
Have the mortgage. So now you could give yourself potentially depending on your mortgage or whatever your mortgage is $1,200, $1,500, $1,800. You got an $1,800 pay raise because your housing expense is lower.
Bingo. So, and to me, that's no different than giving you 300 grand. You making 4% on the investment with you. It's equivalent to $300,000 and freeing up $12,000 a year, just on mortgage payments.
Yeah.
So it can make a big swing for a lot of people just by
which goes back to our first goal is efficiency of money, right?
Correct.
And so you got to, one of the things is most people think the key to growing their money, George, is to find better investments that pay a higher rate of return. And usually to do that, you have to take more risk. So I don't like that for anybody, but I definitely don't like that for somebody of that age. I always go back to Warren Buffett's 2 rules. Rule number 1, don't lose money, right? And rule number 2, don't forget rule number 1. So if you could become more efficient and improve your cash flow and, recapture dollars you're losing unknowingly, unnecessarily, that is a big win. And that would be, as I look at this part of that strategy, we're because when I work with people, I'm looking to find the money, right? We're looking at your situation and just, all right, what are opportunities are there? And then we would review them with you, especially if you're this age, to see if this is a good fit. And then I'll tell you exactly what I'm gonna do. We'll look at the numbers and I'm gonna introduce you to George, right?
That's right. Yeah.
I'm staying in my lane, right? I'm not going
Well, I love your conservative approach at that age bracket, because what's great about our product, it's a non-correlated asset, which means it's not, all we're doing is we're taking the housing today, the market value and the percentage we give them based on today's value. But once they lock in, it's irrelevant what right? So it's protected. Their asset is protected. Their program is protected. That kind of takes that uncertainty out of the equation when that stuff like that happens. So I love that approach, Kurt.
Right.
So,
certainty is key.
And the third option, a lot of people ask me, they go, George, well, wait a minute. What happens if the house is 200 and you only give us 80, but we owe 100,000, does it work? And the answer is yes, it can. It just depends. What we do is we bring 80, but that means because your mortgage is so high, you have to bring $20,000 to the table to get rid of that mortgage. So you're prepaying your mortgage off. You're not losing your money. You're putting 20 grand towards that mortgage balance, but we can get rid of your mortgage payments. I had a client in Florida where he was a financial planner. Actually, he had a $1.2 million house and the house was 480. And we can only give him 400. He didn't even blink an eye. He goes, George, here's a check for 80 grand. I'm like, wow, well, that was quick. I said, so you understand the concept? He goes, are you kidding me? He goes, you just freed up $36,000. He goes, how fast can I make up my 80 grand? Less than 2 years.
Wow,
You just saved me 13 years of $36,000 a year. He says, you're going to save me a ton of cash. And then on top of that, the tax strategy you taught me, I'm going to save even more money down the road. So when the light bulb comes on, it comes on.
Right.
It's like,
that's why it's so important to understand how money works. Like, everybody's out there working for money. You've got to understand how money works and stop getting your financial advice from sound bites off of YouTube, right? And or financial entertainers that work with broke people, right? No, okay.
I'm not gonna, I know where you're going with this. I didn't want to say
I'm not even gonna go, you know,
and I'm not name drop. I'm not
nice.
gonna name drop either.
Right.
But I got you.
Right. I was told somebody, listen, you have you financial, I won't say, I don't want to give advice, but financial planning, if you will, is personal, right? So you have to look at your situation and you can't generalize. Like, you can generalize and have an idea, like we're generalizing with regards to the concept of reverse mortgage, but then you got to break down the numbers and see what makes sense for you and the problem that you're trying to solve. And so we're just giving you another, what's it called, arrow in your quiver. Is that the right thing? In your whatever that thing is on the back, that green arrow has on the back. All right, your quiver.
I like the quiver. I mean, that sounds good.
And so anyway, yep. Keep going, sir.
Yeah.
That was 3 or 4? 3.
That was I was still on number 2.
Still number 2. Okay.
Yeah. And so we're just talking about 3 different ways that can happen when they do the appraisal. But the appraisal really dictates the number combined with the youngest of the 2 ages in the household. All right. And then I have strategies, by the way. And again, we can go on. There's so many podcasts we can probably do, but I have strategies for people who have a free and clear home. And I have a strategy for people that have a mortgage, right? So mortgage is very obvious. And that is simply cash flow, freeing up the mortgage payment, and tax strategies that I teach. Where cash on the other side, I work with people like yourself, Curtis, where we talk about how do we use that line of credit efficiently on our program? Because people don't know this, but there's a line of credit feature. It's with this program that has a guaranteed growth rate right now, minimum of 6%. Year if they don't use the money, right? So if they have a $200,000 line of credit, next year they'll have access to $212,000 if they don't need the money. People always say, George, how come you do so many of these clients have free and clear homes that don't need the money? And I says, well, we're preparing ourselves. This is part of the planning process.
Right.
They don't need the money right now. So we let the line of credit grow, and it's growing at 6% a year. So they have access to more funds down the road, and it's all tax-free. That can help them do long-term care strategy planning. I do traditional IRA conversions to Roth. I do so many different things on the line of credit play with clients that have clear homes that it comes in very handy down the road when that time comes.
That's fascinating. Okay. Yeah, because that is another podcast. All right, keep going.
Yeah, we got more. I'm trying to simplify. So
right.
So with that particular, so there's different strategies for people in different scenarios. So I kind of want to hear, when I work with clients, I want to hear their financial story. I want to hear, what do they want to accomplish? How do we use this tool the right way? I don't do a loan to do a loan. Again, it's all part of understanding your money. Like you say, Curtis, like you mentioned earlier in the podcast, where we got to figure out, educate them first and understand how to make this work. But then once they understand, the strategies will come into play because they'll understand the concept.
Right.
All right. So that's number 2. Number 3 with kids was the kids part we talked about. They can inherit the house if they want, but most people don't. And they have up to 6 months to settle the estate. So they have plenty of time to sell the house, pay back the loan, and whatever money's left over goes back to the family. So it's no different than any other mortgage. As a matter of fact, the difference between a regular mortgage and this mortgage is, on a regular mortgage, you got to figure out how to make payments until you figure out when to settle the estate.
Right.
Where in a reverse mortgage, there is no payment. So you can take the time, figure out how to sell the house, and you can even get 3-month extensions up to a year to settle the estate.
That's what I heard. I heard so I was probably saying it wrong. You could get up to a year, but it's really 6 months and then you can get an extension. So here's a scenario that I had. And so, because that's why I say it's part of a plan. So I'll give you a worst case scenario that I experienced. And this was, to me, somebody did it with lack of planning. So my sister's a social worker. This was in Philly, in the inner city Philly. So they did a reverse The mother passed away. The daughter was 40 something, but was like $1,300 a month on SSD, right? And she didn't have the wherewithal to buy the house or refinance it. She just didn't qualify. And so she was kind of mentally paralyzed. I really nothing I could do for her. So I really sat there with her and helped her. She hadn't even filed the insurance claim. She had like a little $15,000 or $20,000 insurance policy. So I spent 20 minutes and just filled it out for her. Here, sign this. I damn near licked the stamp and put it in the thing because she was just mentally paralyzed, right? And to me, that's a idea of doing it, but doing it with no planning. Because like, if you want your kid to have a house, you got to make provisions, you know what I mean? Like insurance or something that they can re-qualify, and they only did half of it. And so she was, kind of financially handicapped, and it was a bad thing. I have another person that, they already make a couple $100,000 a year. So they could household income. So they could buy the house back if they wanted. So I told this person, listen, I'm not worried about you want to get the house. I'm worried about your mother living the best life she can for the rest of her life. Okay. You can figure this out. And I hope you figure it out when that time comes. So I think the story is what people think about. Okay. And so that was expressed. I just wanted to put that out there because I want to get into some, stuff that I've seen out there. And, how would we approach? Like, I probably wouldn't have let her done that, or I would have just talked through. I don't know if I would have let her done it because it's her money, but I would have said, okay, well, what would happen because not if, right? It's when something happens to you, to your daughter. What are your concerns about that? I think that conversation needs to be had.
Oh, absolutely. I mean, once I hear story, once I find out their background, and you brought this up the last time you and I spoke about that scenario, by the way. So as soon as I hear something that somebody wants to take care of maybe a handicapped or some kind of a disability of a child, and they're the ones really are the main caretakers, and they're in the house.
Yeah.
I don't do a reverse just to do a reverse. There's got to be a planning process. And the first thing I ask is, do you have a family member? Do you have a financial advisor? Do you have somebody that can come in and be included in this conversation piece? Because if your goal is to help yourself and also help your daughter out, we want to come up with a plan that if anything happens, the question is, where does your daughter go then? Who takes care of your daughter at that point? So there are many different strategies that come into play in my head that I've done with other planners, but it's part of the conversation we have to have. It's for example, let's say we have a mortgage payment and we free up $1,000 a month. And what we're going to do with the insurance financial planner that's helping the family out, but maybe we put a life insurance policy to pay off the mortgage when that time comes, so where she can just simply stay in the house, for the rest of her life. At that point, and maybe give her extra money to take care of her. Because if we're freeing $1,000 a month, can they afford a life insurance policy then?
Right.
And the answer is yes, because that, if we free up $300, $400, $500 a month, that can help now come up with that strategy to take care of not only themselves, because we freed up a mortgage payment, we take care of the daughter, and we freed up cash flow to help them make them live comfortably in the house for the rest of their life.
Right. Boom. It's just, you got to think about it and see. So what, George, one thing I always tell people is that, the products that you buy should be a result of your knowledge, not a substitute for it. Right. And so it starts with your investing or business or planning is a team sport. Right. So now I'm introducing you all to one of the people on my team. I'm the quarterback, but of the team, but you need specialists, right? I knew what they were, but I don't want to know everything about everything. I just need to know to know when to call George, right?
Yeah.
And
but you're the quarterback. You just hand it off to the running back.
I'm going to hand it off. Yep.
I'm a running back, so I'm going to help you out.
3 yards in a cloud of dust. So what else don't I know? That was one thing, because I hear that a lot, and I wanted to get that out there. Oh, they're going to take my house. No, they're not. No,
No. If they just pay their taxes, their insurance, but we're talking about planning after that person passes away. That's a different story, right? What do we do next, with the house? Is it something really the family really even wants? That's
Right.
really what we got to find out. And
Right.
but that's a unique scenario because that's designed for somebody that was disabled in the house that needs future care. So that's got to be part of the conversation on the planning part.
Yeah. Yeah. Talk about the ramifications, because you said this, and I actually want to get this in on this call, the ramifications for this and long-term care, or you've got to go leave the house to go into a facility. Then what happened? When does that kick in? Can we talk about that today?
Yeah. So I have a lot of clients. My dad, he broke his back and was in a nursing home for 6 months and came back home. They're not going to do anything to your house. I mean, it's when you're physically in the nursing facility for 12 months or more, then there's a good chance you're probably not coming back. Right. So if that happens because you can go 6 and come back and 8 months and come back, they send an occupancy affidavit once a year to the house to see if people are still living there. That's how they check.
Okay.
But if you're in there for more than 12 months, then that's when we give instructions to the family. Go ahead and settle the estate, pay back the loan, sell the house, take the proceeds. And, because your mom or dad is probably going to have to stay in that facility long term, and they're probably not coming back. So that's when you cross that bridge when that time. Now, when that time happens, the clock starts ticking at that point where they have time to settle the estate after that 12-month period. So
let's go. I'm gonna do rapid fire stuff that's coming on my mind. All right. So now I live here, or I'm in Michigan. Let's say it's cold, and I want to come down there with you, George, at least part of the year, and I want another house. And I've heard people talk about doing that with the reverse, buying a house. Can you talk about that? That is fabulous.
Well, I mean, so again, everything's strategies. I had a client in Sarasota, Florida. They had a $1.2 million house, free and clear. We did a reverse on their primary right there. They wanted to buy a second home. So their second home was not going to be their primary. That there was going to be a second home for that reason. So we got with a financial planner. We talked about some strategies, and one of the strategies was we were converting a traditional IRA into a Roth, and we were using the line of credit to pay the tax liability for the conversion. So we were using tax-free money to pay a tax liability. The second thing we did was we used 20% for a down payment on the second home out of the line of credit.
Okay.
To help buy the house in North Carolina for them.
Okay.
So here's the best part. How much money did we use out of the investment portfolio?
Nothing. Yeah.
We used housing wealth to go ahead and take care of that stuff, right? So we're protecting the cash bucket. We're pushing the cash out as far as possible, but we were still able to accomplish those particular goals. Now, on the flip side, if somebody's living in Michigan and they're getting up in age and they're like, they like it down here in Florida, you just have to live here at least 6 months out of the year. So what I would do is, if you're in Michigan, I would make the primary residence in Florida and live here and homestead the property here and because there's no state income taxes in Florida in this example. And we make that's the primary. And if you live here 6 months out of the year and live 6 months in Michigan, you can do that.
And still keep the reverse and not have any payments on the house.
Yeah.
Wow. Yeah. See, how many of y'all knew that? That's fabulous, right? And we could probably do 2 hours on this, on just the different strategies, folks. So again, it's not the product, it's a strategy. And
there's more. There's God. I mean, I even have more
if you got time to
well, I mean, if I got people that have, for example, portfolio money, I literally show them how to don't ever buy a house cash. If you're in your 60s, 70s, and 80s, do not buy a house cash, because I will teach some tax strategy play on how to buy a house with less cash, put more money in your portfolio, and still take advantage of the tax strategies I show to protect your investment down the road. And these are different strategies we just try to show to help protect their family legacy, right? That they want to leave behind. And believe it or not, when we do these strategies, we end up reducing tax liabilities, increasing cash flow, increasing net worth, and we actually have a larger legacy to pass on to our heirs. That's what ends up happening when we strategize with this product. That's how much of a difference it makes.
Wow. Yeah. That's fabulous.
And I got point number 4 real quick. And this is something I always explain to clients too, is closing costs. Closing costs are a lot more on a reverse mortgage because it's not a conventional loan. It's an FHA loan.
Mm-hmm.
2% of the 4 to 4.5% to 5% of closing costs go right to FHA. It's a funding fee to insure the loan. But here's what I ask clients all the time. I say, guys, let me ask you a question. Let's say we did the strategy and your house was worth 400 grand and you borrowed 200 and you lived 20 more years in the house and you didn't have to make a mortgage payment for the rest of your life. That 200 grand with interest grew all the way to 400,000. I'm going to be hypothetical, worst case scenario, devil's advocate. Let's do it all, right? And the 200 grew to 400 by the time they both died. But we had a market crash and the house is only worth 350, but they owe 400.
Okay.
Now the kids are going, thanks, mom and dad. You know, you left me a house that's only worth 350, but you owe 400. So I tell them all the time, I said, clients, you know, who do you think has to pay that difference, that 50 grand? Somebody's got to pay it. So
Right.
who writes that check for that upside down 50 grand to the bank? Is it the kids? Or do they call Curtis and say, Curtis, you need to liquidate our assets because we got to come up with that 50 grand? Who do you think has to pay for it?
Yeah, hopefully neither.
Hopefully neither,
No,
but the
neither.
answer is it is neither.
Okay.
But this is where people have misunderstanding.
Right,
It's
exactly.
a non-recourse loan, which means that whoever's left behind, there is no debt, is responsible.
So you can't be
I'm sorry.
upside down. In other words, you can't.
Well, let me clarify. The
Yeah.
children or whoever's left behind is not responsible for any debt that's left behind. So who writes the check? Well, it's FHA. FHA writes the check to the bank for that.
Because that's
upside
what
down.
the insurance, that's what that is for.
Bingo.
That's the insurance.
But that's why the costs are a lot more than normal,
Right.
because it's 2% more to utilize a strategy. So you're not passing on debt to your children, because parents, you know, they love the concept, but they're afraid to leave something negative for their kids. So this is what I'm trying to reassure them, that they're not. You know, we need to take care of you, but your kids will be taken care of. They'll be fine because
Right.
of the rules that are in place. And that's why it is the most safest today, the sensible way to do this concept, because FHA is involved. And then
Wow.
point number 5 is
Mhm.
fear. And that's what we talked about, the absence of knowledge. Fear is just people hear these stories. It's not accurate. But I'm telling you, if they call me and follow my lead, I will literally show them a way to protect their investments, work with the financial advisor or the insurance agent or the financial planner, and we will do everything we can in our power to work together as a team to
Mhm.
figure out how do we make your money go further. This is not a one man, this is a team effort. It takes a village. So this is what we're going to do, is we're going to form our team to help that client out. That's why I love teaming up with people like yourself that want to get educated, that are educated actually. And that's why I love working with Circle of Wealth people too, because I have my own software. I showed the tanks,
Mhm.
and I could show them visually on a Zoom meeting how these tanks really do work when you implement this strategy.
Right. So those of you who've never spoke to me, we all operate from something we call your personal economic model. And so we illustrate money flowing through your life through a series of tanks. And yellow tank is investment, the green tank is liquidity, there's the equity tank, and it allows us to just, pictures are worth 1,000 words, right? And so you can do that. And so you know, I like working with people that get that, because usually I can show a client and say, look, I want to start with this picture, because every conversation we need to have in your financial life, we can have on this one screen, right? And just go deeper. And it's just a fabulous tool that we're talking about. Was that 5 or 4? You want to do the last one?
No, we did 5.
We did 5. Okay. I'm losing track with that, because I'm
Yeah,
getting off. I'm thinking about all this other stuff that we could do, but
yeah, there's so much. I mean, there's more to this, like I said, but I've been doing this for a long time. So it's the experience is knowing what not to do, right?
right,
So,
right.
so my big thing is, like I said, I love to help clients out. I'm a big advocate, and if it makes sense, it makes sense. We'll do it this way. But there are some suggestions that I make that for a lot of people out there, they're picking the wrong product. I'm not saying this in our industry, but our industry, we have a lot of people that do loans. They do
Mhm.
loans to do loans. I do it as a retirement strategy. So
Right.
I don't even like to call it a reverse mortgage. I actually like to call it a retirement mortgage. That's why I call it myself a retirement mortgage specialist, right? So this is something that I'm trying to message and change the way retirement is done in this country with this loan.
Right.
And I really believe this could be a fantastic tool if utilized the right way.
It sounds like it. I guys, if you're so what should if they how do so and here are two sets of people that should be thinking about this. I think it's if you're what 62 or older, and or you've got parents that are that you're dealing with, and you're you may need to start to help them with affairs, then you need to have a conversation with your with George, with their advisor. If you don't have anybody that understands this stuff, call him, or if you want work in conjunction with me and him, to where you got some people that we're speaking the same language, then that's I think that's and it's just a conversation. We don't charge for having a conversation, and then we can see if it's good for you or not. So with that being said, George, what's your preferred way if they want to know more about this? Something that maybe you can we can put in the show. I think we have something in the show notes that we can give them as a starter. And then how would you like them to touch base with you? Should should this be a good fit, or just see if it's a good fit?
Yeah, what we can do is, I mean, maybe you and I, Curtis, we can come up with something as far as maybe working together to, they can maybe fill out one of those case study sheets that I have, and they can just send it, directly to me, and I can call them up at a certain time, and we can go over the subject matter on a private matter. My information too, I'm on LinkedIn. I work for Fairway Independent Mortgage, and even though I'm located in Florida, I team up with financial planners up and down the East Coast. So, and I have people in the West Coast, but we team up with everybody to kind of teach these same strategies. So, if they can right now just kind of reach out to you to kind of get my information, that would be greatly appreciated.
Right. So reach out right now. I will do it. I'll probably make a landing page out of it right now. If you're hearing this, just email me at curtmay, curtmay@gmail.com because I'll update that in the show notes. And then we will have a conversation. And then George is giving me some information that he wants me to kind of get you organized. And then what I can do is make an introduction. Yep. Rather than calling out, asking a lot of questions. Let's make sure this is a conversation that you should have, because it's not a conversation to have in a vacuum, right? You need to see kind of where you're at, and then is this a good fit? So it's probably as self-serving as it sounds. You need to start with me. Okay.
No, I do. That's actually where I want him to start with, Curtis.
Yeah.
Curtis, as far as start with you. You made an interesting point, just real quick to kind of wrap up, I guess, on this concept. You made an interesting comment that even the kids that are not people that are not in the 62 age bracket, and they might know something about their parents. I'm going to tell you one thing that's been very common in Pennsylvania that I've been running into in particular. There are a lot of people still stuck in a 2-story house, and they just there's too much maintenance. It's too big of a house. It's a ranch style type home, so it's a lot of work, right? As they get older and age in place, they just want something smaller, less maintenance. We call it right sizing. I don't even like to call it downsizing. Right sizing, to make it more comfortable for them. So I show clients with the kids how to capture that housing wealth by selling the home. I'm going to show them how to take part of that cash and show them how to buy more of a house with less cash, put money back in their portfolio, and have no mortgage payments for the rest of their life, and get them out of the 2-story house. Because you can buy a house with this product.
Yeah, so I don't know that. I mean, so much. So we just scratched the surface. So I think definitely let's talk about it and kind of see where you're at. And then there's, your parents may need to discuss it, or we can have a family, I do family Zooms all the time with people to kind of go over the concept. We could probably do a family Zoom just as but I think we give you a lot on this, but we can definitely go into it. And this is a big conversation, guys. And the whole idea is we want you to live the best life you can for as long as you can, right? And that's the goal, Cecile. So what's the result of this conversation? You living your best life. Okay. So that's what we want.
Living your best life, right? You got to take care of this generation, right? We got to figure out how to make their money go further.
Yes. So George, thanks for joining us on the Practical Wealth Show. And like I said, if you're listening to this on the show, I want you to go to the YouTube channel, and you'll see it up where we did a little bit of a screen share. We went over some education if you're more of a visual person, and listen up, tell a friend, and let's go out there and I want you again, be secure. Let's not run out of money. And leave a legacy if that's what you care to do. It's all a conversation.
That's it. Let's change people's lives and change the way retirement is done in this country. And it's a crisis right now. We need to help them out with this. And this is a product that can help out in that area. So thank you, Curtis. Appreciate the time. And thank you for having me as a guest.
Yes, my pleasure. Anytime. And I thought of like 3 more topics. So like do this again. So I appreciate you, and go out there, guys, and have a great day.